Okay guys, here we go. We're going to be covering Chapter 1, Risk and Return. This is the Jordan et al. Book, Fundamentals of Investment, Valuation and Management. These are the PowerPoints for the book. You can find the PowerPoints on Blackboard, so go ahead and look for them and download them and open it so you can go ahead and follow this video using the PowerPoints. We're going to be covering one of the most fundamental relationships in all of finance, which is the relationship between risk and return. There should be some relationship between how much risk you take in an investment and how much return or reward you get in that investment. This is extremely important. This is, like I said, this is the fundamental relationship for finance. So let's go ahead and take a look at it. So there are two key observations. The first one is that there's a substantial reward on average for bearing risk. The second one is that greater risks are accompanied with greater returns, generally speaking, over time. These are important investment guidelines. So first, let's go ahead and define total dollar return. So there's a difference between total dollar return and total percentage return. Total dollar return is the return on an investment measured in dollars, accounting for all interim cash flows and capital gains or losses. So this is the total dollar amount return. So if you look at this equation down here, the total dollar return on a stock should be equal to the dividend income plus the capital gain. Okay, so basically total dollar return has two components. One of them is dividend income, the other one is capital gain. Dividend income is the income you would get as a shareholder from a company. So a company has a certain amount of earnings. Those earnings get paid out to shareholders in the form of dividends, and that would be your dividend income that you receive as an investor in that company. The second source, which is the capital gain or the capital loss, comes from actually buying the stock and then selling it later at a different price. So let's say you bought a stock for $10 and later on you sold it for $12. That $2 difference is what you call a capital gain. So one of them is a dividend income that you receive from the earnings that come from the company, and the second part is the capital gain that you get from investing in it, and there's a price appreciation. The second type of return that we're looking at is the total percent return. So this is the same concept, but just in percentage instead of just absolute dollar amounts. So again, there's two sources for this return. One of them is, if you look down here, one of them is dividend income, and the other one is capital gain. But the dividend income and the capital gain is actually scaled by your beginning investment or your beginning stock price. So the percent return on a stock is equal to dividend income plus capital gain divided by the beginning stock price. This is where you scale. You're basically scaling your gains by the initial investment that you made. So you're going to end up having a percent return on your investment. That's the percent return. Okay. That's the percent return that we talked about. So let's look at this example, how to calculate total dollar and total percent returns. Suppose you invested $1,400 in a stock with a share price of $35. Okay, so each stock is worth $35. After 1 year, the stock price increases to $49. Okay, so what's the difference between your initial purchase price and the stock price increase? There's a $14 increase. Okay, so that would be your capital gain. You went from buying it at $35 to having it appreciate to $49. As far as dividends, you received one dividend payment of $1.40. Okay, so what is your total dollar return? Your total dollar return would be $1,400 that you invested divided by $35 per share, which gives you 40 shares. You ended up purchasing 40 shares. You own 40 shares in the stock. The capital gain was over 40 shares, as you can see, and you had a $14 capital gain. Because remember, you bought it at $35, and now it appreciated to $49. So $14 multiplied by the 40 shares gives you $560 worth of capital gain. Now in terms of dividends, you had 40 shares, you got $1.40 for each one. That gives you a total of $56 in dividend payments or dividend income. So it's $1.40 multiplied by 40 gives you the $56. So what is your total dollar return? Your total dollar return is the sum of the capital gain, $560, plus the $56 in dividend income. That gives you a total of $616 of total dollar return. This is your total dollar return, $616. So notice that your initial investment was $1,400, and then you ended up making $616 off of that investment. Now, another way to look at this is in percent return. What is your total percent return? So your total percent return was $1.40, right, for the dividend income, divided by $35 that you initially invested. That gives you 4%. So this is known as the dividend yield. Dividend yield. The dividend yield is the dividend paid divided by the initial stock price. So dividend paid divided by the initial stock price gives you 4%. As far as the capital gain is concerned, the capital gain, the way you calculate that is the ending stock price minus the initial stock price divided by the initial stock price. That gives you 40%. So ending stock price, which is 49, minus the initial stock price, which is 35, divided by $35. That gives you 40%. So what is your total percentage return? Excuse me. Your total percentage return is going to be the sum of those two components. The dividend yield plus the capital gain yield gives you 44%. So 4% plus 40% gives you 44%. That is your total percent return. Okay, that's how you would calculate it. Again, note that $616 divided by $1,400 is 44%. That would be another way to calculate it. Okay, so it's very important for you to understand as an investor, it's very important for you to understand what returns you're going to get if you invest in different types of assets or different types of asset classes. So for example, if you invest in very large companies, you know, what kind of return are you expecting to get on average if you invest in really large companies? What if you invest in really small companies? What if you invest in treasuries or maybe some long-term bonds? It's very important for you to understand the different types of returns that you get out of these different types of stocks or these different types of asset classes. So for example, if you were to invest $1 in 1926, investment of $1 in 1926, and hold on to that dollar investment, buy and hold strategy basically, all the way to 2012, this is the growth that you would see in that dollar. So for example, if you invested $1 in 1926 in small company stocks, a portfolio of small company stocks, that dollar would have appreciated to $21,997. So $1 would grow to $21,997 if you invested in small company stocks. What happens if you put that money in large company stocks? That same dollar would have grown to $3,247. Notice that there's a huge difference between small stock returns and large stock returns. Large stock returns produced way smaller returns compared to small company returns. So now what if you invested that in long-term government bonds? So these are like 30-year federal government bonds or maybe 10-year federal government bonds. If you invested that dollar, it would have grown to $112, which is way lower than the large company stocks or the small company stocks. And what if you invested that in treasury bills, which are very safe short-term government bonds or government notes? It would have grown to $22. And then, you know, what's the value of $1 today, in today's terms, as far as inflation is concerned. $1 back then was equivalent to $12.83 today. So what can you learn from this graph that you're looking at right here? What you can learn is that, first of all, that stocks provide greater returns to investors on average over the long term compared to government bonds or even treasury bills. So stocks, generally speaking, provide higher returns than bonds. The other thing that you learn from this graph is that small stocks provide greater returns than large stocks. Okay, and then of course, long-term bonds provide greater return than treasury bills. Now, what's the relationship that all of these have? Well, the difference is the risk and the return. Small company stocks carry a lot of risk. Large company stocks have less risk. Long-term government bonds have more risk compared to treasury bills, but are not as risky as stocks. So what you're seeing is that as we go down this chart right here vertically, there's a decrease in the risk of all these different asset classes. Notice how the treasury bill line is relatively, it doesn't oscillate as much, whereas the small company stock line oscillates a lot more, so there's a lot more risk involved. So the greater the risk, the greater the expected return. That's the whole idea or the whole lesson of this. So as far as financial market history, what about the different, you have stocks right here providing greater returns, bonds providing lower returns, bills providing lower returns, and look at gold. Gold hasn't provided such a large return. And then the CPI is the inflation. Notice, look, these are the returns, the annual returns for large company stocks over this 100-year period, more or less. Notice the range, right? Some years had incredible returns, like right here, close to 50 or greater than 50% return in a single year. But over here, you had really large negative returns, like negative 40% or negative 20-some%. So there's a spread, right, in returns. Now look at the small company stocks. Small company stocks, one year had almost, had greater than 150% return, where other years you had, minus 50%. So if you look at the spread or the riskiness of small company stocks versus large stocks, you see a lot more risk here with small company stocks in a typical year.